Hello, welcome to this lecture number 17. In this lecture, I shall discuss about the meaning of different items of profit and loss and balance sheet and the core fundamental principles of finance. Because if you know the meaning of different profit and loss, different items of profit and loss and balance sheet, you would be able to find out the position of any business entity by looking at the numbers of profit and loss and balance sheet. Subsequently, I shall discuss about the fundamental blocks of finance, that what are the fundamental concepts of finance. So let us start. Till now, what we have discussed, that how to prepare profit and loss and balance sheet from the financial transactions through double entry system, both for the first year and in the second year of operation of a business entity. Since we know this, that how the profit and loss and balance sheet will be prepared, I have taken the last balance sheet and profit and loss, and now I shall discuss the different meaning of different items of profit and loss and balance sheet. Now, if you can recollect that any inflow of fund would be captured by passing a debit entry, where the first entry would be the debit balance sheet asset bank. Whereas the second entry can go to any part of the asset and liability of the balance sheet, or profit and loss, or income or expenses. Now, first, what we have to discuss is that the first entry, which is be the immediate inflow, will come in the form of a cash and bank. Now, if we want to know the meaning of any item of the profit and loss and balance sheet, first we have to determine whether it's a first entry or second entry. Second, what we have to discuss also, what is the closing balance? Is it a debit or is it a credit? And from that, we can find out what is the implication of that particular item. Similarly, if we look at the deferred inflow, would be captured in the first entry, debit balance sheet asset receivable. Now, what is the deferred inflow? That means the inflow will come later on. But if we try to analyze as on a particular date, what is its impact? It is an outflow. So a deferred inflow can be treated as an outflow as on the date of the analyzing this financial statement. Similarly, if we look at it, first entry deferred outflow would be coming here. So this gives you a very clear-cut picture that in balance sheet, if the first entry will always be either bank, cash or bank, or receivable or creditor for expenses. Now the second entry would be the anywhere it can go, whether it's a profit and loss balance sheet, anywhere it can go. Now let us take some example and try to explain what is the meaning of different items. Let us look at it. Now, what we'll do, let us check. Now, say for example, what do you mean by plant and machinery of 50 lakhs? Now, first of all, to understand the meaning of plant and machinery, first we have to find out whether plant and machinery is a first entry or a second entry. As we have discussed in the balance sheet, first entry we can be bank, cash and bank, receivable or creditor. But the second entry can be, the remaining part would be the second entry. So if we apply the logic, so that means plant and machinery is a second entry and second entry is a debit. If second entry is a debit, that means first entry is a credit. First entry is a credit means outflow. So plant and machinery means the business entity has already incurred an outflow of 50 lakhs of rupees. Now the question here is that whether this is good or bad, that depends that whether this outflow is generating desired income or not. So it means that plant and machinery 50 lakhs means an outflow has already happened. Next, if I check security deposits, if it's a security deposit, same logic, whether it's a first entry or second entry, second entry debit means first entry credit. So again, it is an outflow. Similarly, if we look at term loan. Now, first of all, term loan is a first entry or second entry? Definitely second entry. Because first entry will belong to only cash and bank, receivable and creditor. So it's a term loan. If it's a term loan, next question is that what is the balance of the term loan? Since it's a liability side, so the credit balance. So term loan is a second entry credit balance. If it's a second entry credit balance, means first entry will be debit balance, so that means an inflow. Now the question is that whether this inflow is good or bad. Next we have to check this inflow in the liability side means payment has to take place. It will result in the future outflow. So if it is resulting in a future outflow, whether the business entity would be able to pay it on time or not, that's an important part. So term loan represents that the business entity has already got an inflow which has to be paid in future. Similarly, if we look at cash credit is also an inflow, same logic. Now we'll talk about capital. Now capital means it's an inflow. Because the same logic, liability, credit, second entry. So first entry will be debit, so that's an inflow. So inflow has happened. So this amount, it has to be paid back in future. Now, similarly, sales. If it's a sales, it's an inflow or outflow. Same logic, sales is a second entry credit, first entry is a debit. So that's an inflow. Now, what does it mean? A sales means for a particular year, how much the business entity has earned, which is a permanent inflow. Similarly, if you look at electricity expenses, first entry or second entry, second entry. If it's a second entry, so what will happen? Next, we have to check whether it's a debit or credit. Since it's an expenses side, debit. Second entry debit means first entry credit is an outflow. So it's an electricity is an expenses where the company has incurred for a particular period. So like this, now you are very clear that every P&L and balance sheet and asset and liability, you have got a complete clarity. So we started with no knowledge. Now we are very clear about what is the different meaning of balance sheet, profit and loss, different item. Let me sum it up. All asset except cash and bank, it means an outflow of fund has already happened. All liabilities, this is basically all liabilities. It is talking about all liabilities, means an inflow of fund has happened. Now income is an inflow, permanent has happened, whereas the expenses is an outflow where the outflow, what has happened? The outflow has actually, outflow has gone out. Now let me slightly change it. If you see here, it should be the credit increase in finished goods. So if you look at it, it's a red mark. What does it mean? It's a credit increase in finished goods. So it's a credit increase in finished goods. That's why I have changed it. Why it's a credit? Because it's a negative. Since it's a negative, it's a credit. How it has arrived at, you can go back to the previous sessions and you can find out. So what does it indicate? It indicates that in this case, there is an inflow has happened. Credit on expenses sides. It's an inflow, means by that amount, the cost has gone down. So this is an important entries. This is not a non-cash item. So that's why this entry is credit here. So it will see the WIP is also, the finished goods has gone down by 3 amount, gone up by 3. So if we look at it, so by this way, you can get the meaning of profit and loss and balance sheet. So accounts part is over. Now, one of the major problems people face from non-accounts background is that how to understand the meaning of accounts, how the financial transactions to accounting entries created, how the financial transaction to profit and loss and balance sheet has been created. So by this time, you're absolutely clear that how it is being created, how it has been actually prepared, and what is the meaning of different items of profit and loss and balance sheet. So accounts part, which creates a lot of inhibitions, a lot of fear, apprehension among the minds of the non-commerce student. I think all of you has got a lot of comfort about it. Please remember that if you have any problems, I would be available. So please send me mails, you can also call me in my number, no issue on that. Now, once we have got the accounts ready and our fundamental block is very strong, now we shall discuss about fundamental principles of finance. Now, if you look at the fundamental principles of finance, in the case of the fundamental principles of finance, there are 4 fundamental principles of finance, 4 fundamental principles of finance. First is that maximize income. You have to maximize the income through volume-driven sales growth. So your maximization of income can happen because of sales growth, which can be volume-driven as well as a price-driven, price per unit driven. Always remember, volume-driven sales growth is permanent. price per unit sales growth may not be permanent. So if any business entity is increasing the income by volume driven sales growth, that is good. But if it is price driven sales growth, for the time being, the business entity may be doing well, but in future, how if the price comes down, how it is going to maintain the sales growth, that business entity has to prepare. Next, second fundamental principle is the minimize expenses. When you minimize expenses by operational efficiency. Minimize expenses does not mean hampering customer services. So second fundamental principles of the finance is that minimize expenses through operational efficiency. Apart from that, you can also minimize expenses through financial and taxation efficiencies. Now, classical cases why Apple has got a lot of subsidiaries abroad, why Google has got a lot of subsidiaries abroad. Because of the tax efficient structures abroad, their major money is lying in abroad. So by creating a tax efficient structure, a business entity can reduce the expenses. Apart from that, by borrowing efficiently, the finance cost can be brought down. So minimization of expenses is the second fundamental principles of the finance. Now, third fundamental principles of finance, optimize assets. When you talk about optimize assets, that's a very important point. The prudent non-current acquisition plan. So as you know, non-current assets means it will be used for longer period of time. Before we acquire, we should do the proper due diligence thoroughly. So optimize asset means you should not increase the asset unnecessarily. You have to optimize the assets. So first step is that before you acquire any non-current assets, think several times, debate several times whether it is really worthwhile to take the assets. Now, this is very important. That is called prudent non-current asset acquisition plan. Second part of optimization asset is the better current assets management. So if you can generate more sales to lesser amount of current assets, that is the most desirable. So aim of a business entity should always be to minimize current assets to generate more sales. So that is called better current assets management. Now, the last part of the fundamental principle of finance is that once you optimize the asset, automatically asset equal to liability. Accordingly, what will happen? The equity and liability will also go down. So whenever optimize equity and liability, that means how much percentage of your asset will be funded by taking the money from outside in the form of an equity or in the form of a debt. Now, proper capital structure is a very important point. That means the structure which will result in the minimum cost of raising fund. That would be the optimal structure. Apart from that, an entity must manage their debt well. So that means they should borrow at a lower cost. They should borrow through different instruments where they should pay the lowest amount, and also they should pay the debt in a proper manner, and they should not also borrow excessive amount. So if you know these four fundamental principles of finance, if an entity pursue, then entity is doing the proper work. Irrespective of their job, if you're working in any department, you should always apply these four fundamental principles of finance. Thank you so much for watching this lecture.